Today I think this is the last chapter of this training. I'm not introducing myself because I mean, if you follow these videos, this is the 28th video. You know why I'm here. Let's start analyzing the pro and cons of being a public company. That means make an IPO. So the pros are easy to understand. One, it gives you, it push you on the boundaries to build a solid process and gives discipline. I mean, to report financial numbers, to have a governance control, to define the right compensation package. Those are all things that a public company push you to get in place and to run correctly. Uh, Being a public company CEO or executive expose you to the smart people out there, from bankers to banks to other CEOs. You can literally reach everyone, and there are very intelligent people out there. It provides a lot of liquidity for employees and shareholders. I mean, if you have a stock options, restricted stock unit, performance stock unit, you name it, a compensation package, your employees can sell and make real money out of them. Also, early days investor can cash in a proper and fashion manner. Different from executive and C level. I mean, when you sell, the market always asks why to sell, and you are tied to blackout period and others. It's not an easy task for executive and CEOs, C levels to sell. And of course, it's the most incredible learning opportunities in your life. I mean, this is an incredible journey that teach you a lot. Why not to do it? Or, I mean, the downside of a public company, you will lose flexibility. Many processes will create rigidity on executing things. Second, the market usually is linear in the way of thinking, and when you have ideas or want to do moves that are out of the box, sometimes the market can punish you, which is, I mean, for CEOs that are always active and looking out of the box, it's painful. The market is short term. They think about the quarter. If you miss one quarter, your stock will be punished, and you are priced always for perfection. I've heard Donald Trump one day say we need to remove the quarterly earning and move to 6 months, which, in my opinion, makes sense because, I mean, it's there is less volatility in 6 months in terms of reporting financial results than in a quarter approach. There is a huge increase of cost, the endo insurance, all those kind of compensation, consulting firms, audit, lawyers, bankers, fees. I mean, there is a huge upside on cost that will compress the profits. And then there is an increase of liabilities. I mean, you can get sued by investors, you can get sued, or you can have activists pushing you to make certain choices. I mean, if you make an acquisition or you sell the company, you are subject to liabilities and lawsuit. It's a huge part. Uh, how to build an exit? So, uh, first of all the exits start from a product strategy. Your product, your company fit specific buyer. The exit strategy should be always a part of your brainstorming of speculative thinking. It should not be a priority because the priority is growing the business and make the company appealing, sustainable leader of the sector, etc., etc. But sometime having an exercise, oh, what will be a nice exit? It's an interesting part. And nice exit doesn't mean only money. You should build a relationship with investment bankers, not at the moment that you decide to sell the company, but you need to start early in the journey to familiarize with the investment bankers that have a practice in your sector, engage them on a quarterly basis, having a 30-minute call saying how they are doing, how the sector is doing, and go under their radar. And The bankers usually, I mean, I do see companies 20 million that want to sell, 20 million revenues that want to sell and want to engage Goldman Sachs. I mean, Goldman Sachs is looking is hunting for big whales. So you need to choose the right investment banker. In an exit and in the raise, you need to set up realistic expectation. If your total addressable market is 100 million, why you raise at 1 billion evaluation? You will never pay back the investment. And sometimes there are investors that are crazier than you, and they do around the crazy evaluation. The less raise you do and the lower the evaluation is, the bigger is the upside when you exit, both in terms of dilution and margin. So the best way to create your wealth is to dilute very little and to sell at the right price without waiting. Otherwise, you're not gonna never sell. Uh, an exit is a concerted effort between executive, board, and investors. It's a team game. Also in timing, you need to align your timing and your expectation on exit with your investor expectation. A business is can be, uh, structured to be to focus only on growth, and this create very inefficiencies on profitability and frugality. Profitable and sustainable growth is something interesting when you are a certain size, let's say 500 million, growing 20% with 20% EBITDA. That means 100 million per year. It's incredible. Or can be focused on profit. That means cutting a lot of cost, also cost related to innovation and expansion. So my rule is a grow business that is maximum minus 10% EBITDA. It's a business that where you can revert EBITDA in 3 quarter to profits, and it's the way I would run a business. Uh, So, building an exit IPO. There are three exit: IPO, strategic, and private equity. This is the IPO part. You need to prepare 2 years ahead. You will run a beauty contest, which means choosing the bankers that will be the underwriter, the right, the left, and all the other bankers that will team with you during the IPO. You will do the test in the water, means speaking with around 20 asset manager, private equity, venture capital, all the investors. I mean, private equity usually don't invest in public companies, but who knows? And then you test the appealing of the offer, both in terms of value proposition and price. Then, when the test in the water provide good result, you are doing the roadshow. Means couple of weeks, 3 weeks before the IPO, you meet around 8 buyers per day for 2 weeks consecutively. Usually are 7 buyers, a single asset manager, private equity, hedge fund, blah 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 blah, family offices, and one group meeting per day where many buyers are together, and you pitch your IPO story. And usually, it's always also useful to define which part of the fork you are in terms of pricing, higher end, lower end. And then you do the IPO. The 2 days where the bankers, the underwriters, and others are selling your stock, and then you have what the most addictive thing in your life, which is an app. This is now a desktop version because I couldn't find any better in the internet, but it's like an app on your phone that shows how many buyers are subscribing for your IPO. What I mean that your IPO is your app is populating by this asset manager is buying, is committing to subscribe on the IPO those number of stock at this price. And usually, what you want is one, an oversubscribed book, 2 3 times is great, at the higher end of the fork. And then those commitments will be distributed proportionally. The second part is selling to a strategic. That means an industrial player. First of all, you need to have a product fit. I mean, your product should fit to the strategy of the buyer. The buyer should have a competitive advantage, which is the thesis why they're buying you. It's because they want to expand geographically. It's because they struggle in innovating, so they want to buy something more innovative. They want to consolidate the market. We have seen it on the flip side when we were the buyer in the M&A chapter. Then, in order to get that, you need to go under the radar. And if you need to go under the radar, the best way is to entertain relationship with bankers and those people. We discussed it already. Structure of the deal probably will not be all cash, depends, there are exceptions, but there are part of earnout, part of equity, and then during the execution of the deal, you will be forced to stay many years in the organization that have acquired you, sometime to reinvest part of the proceed. And remember, you will not be the boss anymore, you will have a boss. The third way is private equity. When a private equity acquires you, uh, first of all, this is not for everyone because private equity usually buy big companies and also buy profitable companies because the profit are useful to pay back the debt because they use a part of leverage to buy you. They don't use only their capital, it's very rare, but they also have debt that the target company have to repay. That said, also if you are small, sometimes the private equity exit can happen not directly, but maybe because a company acquired by a private equity fund have the thesis to grow through acquisition, and then you can be a target of the private equity target. You need to go under the radar. Investment with relation with investment bankers, relationship with others are important. And what the private equity is looking for? Usually they are looking for 3, 4 times X the return. Also because these 4 times are amplified by the debt. They are not investing all their money, but they leverage through a debt that usually is acquired together with the company. The deal structure, usually you have to reinvest. If they buy you, you as founder, have a shareholder, some of the shareholder have to reinvest part of the proceed in the fund. For sure, as manager, you will have carry, but for sure you will have also golden handcuff that are, you know, strategies to retain you for long time. So it will not be. It's very rare a full cash exit from day one. So it's done. The training is finished. This is the last video for this part. I have other ideas, but for now it's finished. My wish to you is be consistent, be a $400 million revenue business, don't raise too much capital.